In this video presentation, we are going to see different types of market orders. Using our Odin trading platform, you can place different types of orders like market order, limit order, stop market order, stop limit order. These are all the terminologies that are used. Now let us try to understand the basic concept behind these terminologies. This is our trading platform Odin. Now we are going to see how to place a market order. So in order to purchase or sell any commodity, what you should do, go and click on the particular commodity, press F1, or you can see the icons available on the top and you can use that. So if you notice that in gold Guinea, at what price I can buy gold Guinea now? At 24,464. This is the best next available price for me to purchase gold Guinea at present. Now the market is low. So if there is any news, fundamental news, or if the price is breaking any major support or resistance zone, the market will be fast. If I want to purchase gold Guinea immediately at the next available price without placing any price here, so in the price column, if you see, if I remove everything and I am going to keep this empty, now I am going to place an order. Once I press submit, now you are going to see I am going to purchase gold Guinea at the next available market price. Even if the price changes, for example, you can notice that earlier it was 24,464, now it is 24,469. so it keeps on changing. Within the moment I try to place an order, it can change. So if I purchase any commodity or sell any commodity by keeping the price as 0, now I am going to place this. Now we are going to see it asks for submission. I am going to do it. Now we can notice my order is bought at the market price, which means the next available price. So this is called market order. Now I am going to place a sell order. So what I did, just I am going to repeat it again. I am going to place the cursor on any commodity and then I am going to press F2. So I am going to remove this price column, which means that I am going to place a market order. So if I press submit, and you can notice or see, once I place this, the order gets executed immediately. Now the best price for selling is 24,461. just keep watching it. Now I am going to press S. So this is called market order. The next available best price, whatever price it may be, the order will be executed. That is called market order. Now let us see the advantages and disadvantages of placing a market order. When you place a market order, it guarantees order fills, which means that there is 100% guarantee that your order will be executed. Like you can see, all my trades are executed here. When I place the market order, there is 100% guarantee that all my orders will be executed. But the drawback is it doesn't guarantee price, which means that since I am keeping my price when I purchase any commodity, since I am keeping the price as 0 or empty, it does not guarantee the price, which means that if I want to place a buy order as the market order, so now the price is 24459, which is the next best available price for buying. You can see the sell price. So there is no guarantee. Suddenly when I place the market order, if the price got changed, so now I am going to place the order. Now you can see the price got changed to 24460. So if I had placed the order, it would have been executed at 24,460. So I'm going to cancel it, which means that it guarantees order fill. 100% there is a guarantee your order will be executed, but it does not guarantee the price at which the order is going to be executed. Now we are going to see how limit order works. I want to sell gold guinea by placing a limit order. So what does that mean? So I am pressing F2 to place a sell order. You can notice by default the price takes the next available best market price. Now I want to place a sell limit order, which means that now I want to sell gold guinea at 24,500. So if I am going to place this order, you can notice that I am going to submit it. My order is confirmed and it got placed. At what price? So press F3 and check it is still in pending at the price of 24,500. So what does this mean? This is a limit order, which means that I want gold guinea, my order, to be executed only at 24,500, not a rupee, not a point lesser or higher. I want exactly my order to be placed at 24,500. So if you are going to use or place this type of order, it is called a limit order. So now you have understood what is a limit order. For example, I want to purchase something. So take this case. I want to buy gold guinea, not at this price, at 24,400. So what I am doing, because I am limiting my order. I don't want my order to be executed at some other price. I want my order to be executed exactly at the price at which I want my order to be executed. So if I am placing submit, and you can see my order is in queue. If I press F3, I can see everything is in pending. So this is called a limit order. Now let us take the other case where I can place my limit order. So these are all just the terminologies we use. Just you need to understand the basic underlying concept. So what I am going to do is I am going to sell gold guinea at market price, which means that I am not going to place any price here in the price column. So immediately I am going to sell, I am going to place it. So my order got executed immediately. You can notice that sold here at the bottom. You can see the information sold, which means that my order got executed. In order to confirm that, double check it. So you can see my order is here. So in the trades, my order is here. So after, now you can notice that I have got a sell order, which is I purchased by using sell market order. Now I want to place a target. So I want to book my profit only at 24,400. So what I'm doing is that now I'm placing my target. So just I placed it. So you can notice that what I did, just I mentioned the price as 24,400, which means that I had placed a buy limit order. I want my price target to be exactly at 24,400, not a penny higher or below. So this is called limit order. Now let us see the advantages and disadvantages of limit order. What I am going to do, I am going to cancel all my pending order. So in order to cancel it, you can press F3 and you can cancel all my orders. The advantages is it guarantees price. So it guarantees price in the sense that if the market comes to the price which you had mentioned, at the exact same price the order will be executed, but it does not guarantees order filling. So it guarantees you the price, but it does not guarantee that your order will be filled. For example, in the earlier case, I placed 24,400 as the target. If the price is not coming to that particular point, there are many chances that my order would have not been filled. For instance, there is some major news, fundamental news coming out, so the market is very volatile. There are chances that the market can leave my order, and it does not guarantee order filling. It can, if the price is spiking very fast, so it can leave my order, it can move to the next price range. So the advantage is you get a guaranteed price at the price you want that order to be executed, but it does not guarantee you order filling. Now we are going to see how to place a stop market order, which is a combination of both stop loss and market order. Let me explain this in detail. Now I am going to sell crude oil. So what I am going to do, I am going to sell crude oil, which is going to be a market order. I am not going to place any price, so it's going to be 0. So I am ready for selling crude oil, you can notice that, and I went short in crude oil, so my order also got executed. The next most important thing is to limit my loss. I want to limit my loss, so I need to place a stop loss order. What I am going to do is that I am going to place a buy stop loss order, which means that I am going to change this to SL, which opens this trigger price. But this stop loss order is going to be a market order. So I am going to place a stop loss order, and also it is going to be a market order. So what I'm going to do, since I was sold at 5,976, so I think that till 5,980, so just 4 points I can accept my loss. So I'm fixing my stop loss here. Then in the price area, I'm not going to mention anything. I'm going to leave this as 0. So what I'm going to do, I had placed a stop loss here, which means that when the price reaches 5,980, automatically the order will be triggered at the market price, since I had mentioned in the price column as 0, which means that the order will be executed once the price reaches 5,980 at the market price, at the best available price. So let's see what's going to happen. Now I am going to place this order. So you can see that at the bottom my order is here. So I am going to press F3 to confirm whether my order is here. Yes, my order is here, my stop loss order. Now I am going to wait and see what's going to happen. I could see that the crude price was falling. What I am going to do is that I am going to modify my stop loss order here. I am going to modify my order. So what I am going to do, I am going to decrease my stop loss to 77. Now let us see what's going to happen. Closely watch. Now the price is at 5,975. Just 2 points. Yes, now I'm into it. 5,976. You can see the sell price is 5,976 here. Now the order, now I got it 5,977. So you can see once the price was triggered 5,977, at the bottom you can see my stop loss was triggered at the market price, at the best available price. Why we are placing this type of stop loss market order? Because when the market is volatile, if there is any major news affecting the market, if the market is volatile, this type of stop loss order guarantees me something. I will explain you. It guarantees me order fill. I can be sure that if the market is going and if the price is going to come to that point if the price is going to come to that point, my order will be filled. But since it is a market order, there is no guarantee for the price. If the market is fast, it can be filled at the next price also, but there is a 100% guarantee my order will be filled, but there is no guarantee for the price. That is what a market order does. So if you see that here, now my stop loss got triggered at 5977. For example, if you consider the market is very volatile, so what happens? By default, once the price reaches 5977, it will be filled at the next available price. So it does not guarantee me the price, but it guarantees me the order filling. So that is the reason we place a stop loss market order. For one more reason also, we normally used to place a stop loss market order. I will explain you. Now you can see in my net position there is no open position. In the net lot, it shows the quantity as 0, which means that there is no open position here. The other case where this stop market order will be used in this situation, now the crude price is at 5982. I don't have any open position. Now I think that only if the price moves above a certain point, I need to purchase. Till then I will wait, because that might be a major resistance or key point. Now I think that if the price is going above 5885, then I can go for buying. Till then I need not take any decision. How we are going to put this order? The same way. You can notice that what I am doing, I am going to place a stop loss order, and I am going to keep this price as 0, and I am going to place the price 5985. Now what I am telling, if the price is moving above 5985, you can go for buying. Till then I have not decided to go for buying. So what I am doing is that I am going to place a normal buy order with certain conditions by means of this stop market order. So let me see that how it works. So now we can notice that I am going to place a buy stop loss order, but I don't have any position. You can notice that my order got placed at the bottom here, 5985. Immediately when the price, now we can notice immediately the order got executed because the price got triggered at 5985. You can notice here the order was bought here at 5985. This is also one advantage of using this stop market order. Now we are going to see how to place a stop limit order. Let me explain this you in detail. As the name says that you are going to place a stop loss with a limit order. Now I am going to purchase crude oil. I am going to buy crude oil at the best price. You can see that I am going to buy crude oil at 5985. I am going to place this. So it is a type of limit order. Immediately my order got executed. You can notice that at the bottom I had purchased crude oil at 5985. Now what I am going to do is that I am going to place a stop loss order, which is going to be a stop loss limit order. What I am going to do, I am going to place a stop loss limit order. So I am going to change this order type to stop loss, which means that I need to fill these two areas. One is the trigger price. So what I thought, if the price is coming down below 5980, this is going to be my stop loss zone. Earlier you saw that in market order I kept this price column as 0. Now since I am going to place a limit order, I am going to set a certain condition to the market. From 5980 till 5978, this is going to be my range, which means that from 5980 once my stop loss got triggered from this point till this price range 5978, the stop loss order will be triggered. I am setting a condition here, not any point above this or not any point below this, within this certain limit. That is called stop loss limit order. I am going to explain this again. So in the trigger price, I am going to put the trigger price which I want from this area, from this price till 5978. I am ready to accept my loss. So I have set certain condition, not above 5978 or not below this 5980. Within this two price range, my stop loss order will be executed. Now let us see how this is happening. So my order got placed here. So once the price enters this 5980, immediately my order will be triggered. The price range is from 5980 till 5978. Why we are setting this condition? If the price is volatile, if the market is volatile, it may miss some few price range. We are setting a condition that within this price range only I want my order to be executed. If the price is moving out of this range, I don't want my order to be executed. So this is called stop limit order. So it is a kind of limit order and a stop loss order. This type of stop loss limit order guarantees you the price. It is a 100% guarantee that you will get the price within that limit of 5980 and 5978. But it does not guarantee you order filling, which means that if the market is skipping the price, if the market is very volatile, your price got skipped, but there is no guarantee your order will be filled. It will wait for the price to come to that certain price range, whatever you had mentioned in this case as 5980 and 5978. Only if the price comes back to this range, your order will be filled, else your order will not be filled. So let me sum this up. A limit order guarantees, a stop limit order guarantees you the price, but it does not guarantee you the order filling. Now let us see what's going to happen here. Now the price is staying at 5982. You can notice that the buy price is at 5981. So the condition whatever I had mentioned was when the price reaches 5980, the order stop loss order will be triggered, and with a limited price range till 5978. Within that range, the order can be executed at anywhere, but not above or not below that. Now you can notice the buy price is at 5980. So that was one of the trigger price condition whatever we had mentioned. No, the price was not triggered because if you see the LTP, it's still 5981. Now there is a likely chance that my stop loss would be triggered. Marginally I escape from my stop loss. Now I'm going to modify my stop loss. You can see that how I am going to modify my stop loss. So I am going to set new conditions here. So I need not wait till 5980. I am going to move this to 5982. So I am going to change this. So now my stop loss order got modified. The condition is that from 5982 till 5978 my order can be executed. What I am going to do again, I am going to modify. I am going to set this condition. I am going to bring this condition down to 5980. You can notice that. Now let us see what's going to happen. Again I am going to modify my stop loss. I am going to modify it. I am going to change the limit conditions. That is the reason it is called stop limit order. I am going to increase this to 82 and I am also going to increase this to 84. So I am constantly changing these conditions. Now you can see once the price reaches 5984, my order will be triggered under the certain condition within the limit range of 5978 to 5984. Now I could see the price is around 5985. So there are likely chances that if the price is coming down to 5984, my order will be triggered. I could see the price is moving straight away, so I am going to again modify my stop loss. And I'm going to set a new condition. I am going to wait and see before modifying. Now I am going to see that change it to 5985. So I did it since the price was moving straight away. Now closely monitor that. Now the buy price is at 5986. The set condition was at 5985. Our stop loss will be initiated, will be triggered with a set condition till 5982. We had set that condition. That is the purpose of placing a limit order. Now you could see that our price was at the buy price is at 5985. We are sold out. You can notice that we are sold out at the bottom. The order got executed at 5985. Since the volatility is low here, our order got executed at the trigger price itself. At times when there are major news or events, the volatility will be high. In order to add some buffer, we had set a limited area in which our order can be executed. The area was 5985 to 5982. Within that limited area, our order can be executed at any price based upon the price volatility, not above or below that. That is called stop loss limit order. I hope you would have enjoyed this video presentation about different types of market order. Kindly open a trading account with Goodwill Commodities. Thank you. Take care. Bye.